the Eurozone overall, does it become the next hotspot for investors now that we've maybe calmed things down a bit in Hong Kong?
I think the valuations would be supportive of that statement, certainly. I think that the problem is that growth has been so difficult to come by in Europe for some time that investors will take some convincing that that will be a part of the investment case. Furthermore, the ongoing trade disputes with China will push European markets around to a large extent, and certainly the underlying German economy seems to be suffering some weakness as a result of a lack of or a falling off in Chinese demand.
So Paul, if we take a look at the overall complex, we've put so much emphasis on interest rates. The differential between the U.S. and Europe continues to widen out despite the fact that we have positive interest rates here and negative in Europe. Does that still mean that the U.S. becomes the place where capital ultimately flows, even in times of distress and in times of good?
One would imagine on an underlying basis that the interest rate differential will be supportive of the dollar. It will certainly be a more healthy situation for US banks, but it may well be that as that differential narrows, if the global economy starts to slow down, that you may find that some of those asset flows actually go back to some of those more undervalued currencies. It does appear that the European rate environment will be very much influenced by some secular trends, structural trends that relate to the aging population, the growth of technology, and the difficulty that's been very evident for the ECB in generating growth. So I would imagine that, all else equal, that the US dollar should be the beneficiary of this, but there will be some volatility between those currency pairs.
All right, so we watched it play out markedly yesterday with the headlines, tweets, and everything else between trade in the U.S. and China and tariffs being delayed. The U.S. stock market surged yet again. Is this an environment now where buying dips in the overall stock market in the U.S. and perhaps even abroad is still the base case scenario?
Well, it certainly has been the case. The difference now may be that some of the underlying economic data are slowing. It's certainly our view also that US dollar liquidity is starting to become less abundant for other parts of the world, which will be an issue for growth in certain areas. And to that extent, it may well be that the sort of rallies, the snapbacks that we're seeing in markets will be sharper and shorter than the overall trend, which may remain flat or down. So from that perspective, we would say that buying the dips is probably not the easy option that it has been in the past, especially since central banks are running out of options when it comes to stimulating the equity environment.
Are you concerned about the flatness and almost inversion of that main part of the yield curve, the 2-year to 10-year spread? Is it important for markets and traders right now?
Yes, it is. I mean, it's clearly an indicator of how the market sees growth and inflation going forward. Certainly the idea that the central bank policies that we've seen could inflate away some of this huge stock of debt which we've seen is going away as inflation dies away. And let's remember that the policies which we've seen which have increased debt and brought debt servicing levels down have been there to bring forward demand from the future. But the trouble with growth is that you can't have it twice. So if you've borrowed that future, you can't do that again. And from that to that extent, I think that the 210 spread would give you the idea that there is likely to be some kind of economic hangover at some stage. And also, of course, it will be negatively taken, I would suspect, for the financial sector as well, which tends to trade closely in line with that 210 spread.